Welcome back to the terminal, everyone. Let's take a hard, unvarnished look at advanced micro devices, trading right here in the shadow of major macroeconomic crosscurrents, while retail boards light up with emotional chatter. If you pull up your trading app right now, whether you're tracking Level 2 data on Webull, managing option spreads on Robinhood, or running automated screeners, you will see AMD moving through a familiar high-beta dance. Wall Street's mainstream financial media loves to box AMD into a tired, lazy narrative. They frame it forever as the perennial challenger, the plucky underdog, desperately trying to carve out a sliver of market share in a game dominated by giants. But if you stop looking at the daily ticker noise and start looking at the microscopic physics of modern compute, a completely different reality emerges. The structural blind spot that traditional analysts and emotional retail investors completely miss isn't just about headline-grabbing AI accelerator shipment numbers or quarterly gross margin percentages. It lies deep within the brutal physics of data center bottlenecks, memory wall constraints, and the thermal limits of silicon architecture. While the general public fixates on software hype cycles, the real battlefield has shifted to high-speed interconnects, packaging technology like chiplets, and the agonizing latency of moving electrons across sprawling server racks. AMD is no longer just a component swap for a cheaper CPU. Under the visionary leadership of Lisa Su, the company has engineered a structural shift that bypasses traditional monolithic manufacturing limitations. Yet mainstream sentiment continues to treat semiconductors as a cyclical commodity play, pricing AMD as if every macroeconomic shudder or minor CapEx pause from a hyperscaler spells disaster. This is the precise market mispricing that sophisticated participants capitalize on. When retail investors panic sell over short-term guidance adjustments or macro interest rate jitters, they are ignoring the profound structural lock-in happening inside enterprise data centers. The market often misinterprets temporary supply chain balancing acts as secular demand destruction, creating a massive chasm between how the stock is emotionally priced on social media feeds and how institutional algorithms quietly value its multi-year earnings power. Let's pull back the curtain on how the institutional heavyweights actually treat a stock like AMD during these turbulent market phases. If you monitor the intraday volume profile in block trades, you will notice a fascinating behavioral dichotomy. When macro jitters hit the tape, perhaps a hotter-than-expected inflation print or a sudden geopolitical headline, retail accounts flood online forums with capitulation posts, dumping shares at market open and locking in losses. But look closer at the tape during those exact morning flushouts. Notice how the downward momentum suddenly hits an institutional liquidity wall. That is where smart money steps in, systematically absorbing floating shares through algorithmic accumulation blocks. Institutional players do not care about the emotional panic gripping social media feeds. They care about long-term free cash flow yield, multi-year enterprise design wins, and the inevitable expansion of data center infrastructure spending. They use routine market pullbacks to shake out leveraged retail option speculators, engineering localized washouts that reset the derivative positioning. This creates a coiled spring dynamic in the options market, where heavy open interest on out-of-the-money puts leaves the stock vulnerable to sharp, violent short-covering rallies whenever minor resistance levels are breached. Before we move on to how this powerhouse actually makes its money, let's pause right here. How are you currently managing your exposure to the semiconductor sector? Are you actively accumulating shares during these macro-driven pullbacks, or are you sitting on the sidelines waiting for a deeper technical correction? Drop your thoughts in the comments below. To truly understand where AMD is going, we have to strip away the outdated historical framing that still haunts its valuation. For decades, Wall Street pigeonholed AMD as a low-margin alternative to Intel, a company trapped in the brutal, low-growth consumer PC cycle, constantly battling debt and manufacturing missteps. But that version of AMD is dead and buried. Today's AMD is a high-performance, fabless semiconductor titan operating across three massive high-margin pillars: data center, client and gaming, and embedded systems. The transformation began when AMD abandoned the capital-intensive trap of owning its own silicon fabrication plants, spinning off what is now Global Foundries and partnering exclusively with cutting-edge foundries like TSMC. This single strategic pivot allowed AMD to leapfrog its competitors in process node technology, paving the way for the revolutionary Zen CPU architecture and the EPYC server processor lineup. While legacy framing still views AMD through the lens of selling desktop chips to gamers, the modern business is anchored by enterprise-grade data center dominance, custom silicon for cloud giants, and the aggressive scaling of the AMD Instinct accelerator ecosystem designed to challenge entrenched AI monopolies. Furthermore, the strategic integration of Xilinx brought field-programmable gate aggregates and adaptive computing into the fold, locking AMD into mission-critical aerospace, defense, automotive, and industrial networks that generate sticky, recurring enterprise revenue completely decoupled from consumer PC cycles. Looking out over the multi-year horizon, AMD is positioned as an indispensable technological gatekeeper in the global race for accelerated computing. The multi-year growth catalysts are firmly anchored by the insatiable structural capital expenditure cycles of mega-cap cloud service providers, companies like Microsoft, Meta, Alphabet, and Amazon, who can't afford to rely on a single hardware supplier for their massive artificial intelligence and cloud infrastructures. AMD's annual cadence of rolling out competitive AI accelerators, paired with unified software ecosystems like ROCm, means they are steadily capturing critical mind share and enterprise validation. However, being at the bleeding edge of hardware engineering does not come without profound risks. The semiconductor landscape is a high-stakes geopolitical minefield. Geopolitical tensions surrounding Taiwan and semiconductor manufacturing concentration pose constant supply chain vulnerabilities that no amount of financial engineering can entirely erase. Furthermore, any sudden slowdown or ROI fatigue among mega-cap tech spenders regarding their artificial intelligence infrastructure investments could trigger a broader sector-wide valuation compression. Yet for the disciplined investor, these systemic risks are precisely why the opportunity exists. Short-term price noise, quarterly delivery jitters, and macroeconomic crosscurrents will always create emotional turbulence in high-beta tech equities. The key is to look past the intraday ticker tape, understand the grueling physics of the hardware revolution, and recognize that companies solving foundational computational bottlenecks are the ones that ultimately dictate the future of global enterprise technology. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up. Don't forget to like, comment, and share this video to support the channel.